Good day, everyone, and I hope we are all fine. All right, so we are doing this in continuation to what we did the last time. We are continuing with our questions, right? So in the previous video, we actually solved question 1 and 2. Now in this video, we are going to solve question 3, 4, and then 5. I wouldn't really want the video to be long, so I've actually solved the question. I've written the answers on the paper and I will upload the answers as well. So I will be explaining along how I arrived at this answer and what it means, right? So just like what we've been doing, when I'm solving on the screen, one, it takes a longer time and then the video becomes very long. I wouldn't want that. So I wouldn't want the video to become boring. Get it? All right. So if you are new to this channel, I'll plead with you to like this video and also subscribe to the channel. All right, so let's go. Let's go and look at question 3. So question 3, let's look at the requirements. So the requirement is for us to calculate material mix variance and material yield variance. All right, so let's read the question. Zitamol is a pharmaceutical company that produces a cough syrup by blending 3 different material compounds, namely D, N, and M. So the standard material compound usage and cost per unit of a cough syrup are as follows. So they use 0.51 kg per unit, and then it costs 800 cedis. That's for D. And they use 0.28 kilogram per unit for each unit they produce, and it costs 600 cedis. For M, they use 0.21 kilogram for each unit they produce, and it costs 1,400 per unit. Now, some additional information we're having here is that the actual unit they produced were 5,200 units of a cough syrup using 2,500 of D, 2,500 kilogram of D, 1,500 kilogram of N, and 1,000 kilogram of M. And we are told to calculate the material mix variance and the material yield variance. So now, this question has actually given us the composition that is being used. Some questions will give us the ratio, and they will be like, let's say, material D and M they are used in a ratio of, let's say, 3:1:1. Now you are going to use ratio and proportion to do that. Here they've given us a composition in kilogram. So what we have to do first is we have to add all this composition, 0.51 plus 0.28 plus 0.21, right? But let's look at something first. What we need to do first is to know the formula, where the material mix variance is the standard mix minus actual mix, right? All multiplying by the standard price or the standard cost, something like that. So first, we have to first find the total material they used, right? So we come down, we add all this material, 2,500 kilogram plus 1,500 kilogram plus 1,000 kilogram. We add all of them, we had 5,000 kilogram. Now, because we are coming to check whether the right amount was used, whether they actually used in composition to this 5,000 kg, whether they actually used 0.5 kilogram per unit of it or they didn't, whether they used 0.28 kilogram per unit of they used no or they didn't, whether they used for 0.21 kilogram for every per unit or they didn't. So now what we are coming to this, we add all this 0.51 plus 0.28 plus 0. We are going to get a total of 1. Now we are portioning 0.51 over 1 times 5,000 kilogram. That was calculated here. We get 2,550 kg. 0.28 times over 1 times 5,000, we get 1,400 kg. Then we actually get do for 0 m as for 0.21 over 1 times 5,000. We get 1,050 kg. Now let's look at something here. You can see that based on this 5,000 mix, we can see straight from here that the actual mix that was supposed to be used wasn't used because Here is 2,500 and here is 2,550. Means they use some more than the other. They use some more than the normal mix we are seeing there. So this will lead us to go and then calculate for the material mix variance, the mix variance. How was it mixed? Was it mixed in the right proportion or it was not mixed in the right proportion? So now we bring the material mix variance as we said earlier is the standard mix minus the actual mix. So the standard mix we calculated up here is 2,550. Subtracting the actual mix from it for D, which is 2,500, and then we had what? 40,000 favorable. Why is it favorable? It is favorable because for the actual mix, we use 2,500, but standard mix should have been 2,550, meaning the standard mix is more than the actual mix. And you see, this is in terms of cost. Material is for cost. So anything where for cost, wherever actual is less than standard, it's favorable. But when it is the other way around, it is an adverse or it is not favorable, right? So we do the same thing for N as well, 1,400 minus 1,500, right? Times 600, we get 60,000 adverse. Why is it adverse? Because actual material use is higher than the standard. Now we do the same thing for M as well. 1,050 we calculated up here minus 1,000. That was given in the question. Or that's the actual this in the use times 1,400. We get 70,000 favorable. And then when we add all of them, we are going to get a total material mix variance of 50,000. Now let's look at something here. You see here, we are only comparing the standard mix by the actual mix, not the actual unit, the actual mix. Now let's move to calculating the material yield variance, where the yield variance actually asks the question, was the right amount, like the mix actually yield the right amount of units, right? Or the right amount of output. So it is given by the formula standard quantity for actual mix minus the standard mix times the standard price. All right, so here we are going to do for D. Now what we have to do is we have to apportion all the quantities, the quantities that will be used for per unit. We have to apportion them on the actual unit they produce and then see whether they use the right amount, right? So for this one, we are going to compare it to the standard mix. So you see that material yield variance compares the standard quantity to the standard mix. So it actually takes into consideration the actual unit they produced. So that's what we are seeing here, 0.51 times the 5,200 that was produced, right? That was produced, right? Then we subtract the standard mix from it. We multiply by the standard rate. So with this one, we are going to get 81,600, right? 81,600. So 0.51 times 5,200. So if it were to be ratio and proportion, we would have done, let's say if it was 3:1:1, it would have been, for example, D will be 3/5 times 5,200, right? So this one we have 2,652. So we subtract the 2,550 from it, get 102. Now 102 times 800 is the one going to give us the 81,600. Now, why is it favorable? It is favorable because the standard mix is lesser than the standard quantity for actual, the standard quantity they used for the actual mix, right? So we do the same thing for N as well, 0.28 times 5,200 minus 1,400. Then we multiply by the standard rate, we get this. So when we do all, we are going to get a total material yield variance of 174,000. Now, what's the difference here? The difference is that for the material mix variance, it only compares the quantities or the mix that was involved, right? It compares the standard mix to the actual mix that was given. And for the yield variance, it compares the standard mix it works, or it takes into consideration the standard mix and then the yield, the quantities, what they yield. So it actually wants to extract from the actual output what was the actual input that was used. Do you get it? All right. So now let's move to question 4, Manjo. Right, so let's go and read question 4. So question 4's requirement is for us to calculate the sales price variance. We should calculate the sales volume variance. We should analyze the sales volume variance into the sales quantity variance and then the sales mix variance. I know we are all familiar with this calculation of the sales price variance and then the sales volume variance. What we are not really familiar with, according to my sessions, is the sales quantity variance and then the sales mix variance. So we are going to do that very soon. So I will just leave it with you. Maybe you can pause the video and then solve or calculate the sales price variance yourself and the sales volume variance yourself. When you are done, you come and then cross check and then see whether you are right. All right. So let's read the question. The following information relates to the estimate and actual result of Manjo PLC for the month of January. So the particulars they are having here is we have the budgeted sales unit. So they had 3 products, KO, TO, and then KA. So for the budgeted sales for KO is 36,000, for TO 27,000, for KA is 18,000. The standard selling price is 15 for KO, 10 for TO, and then 12.5 for KA. Standard variable cost is 8 for KO, 4 for TO, 7.5 for KA. Now, actual sales unit is 30,000 for KO, 35,000 for TO, and 25,000 for KA. Actual sales volume, or the sales revenue they had, the sales revenue is 42,000 for KO, 367,500 for TO, and then 325,000 for KA. Now they say we should compute this. So now I'm sure you will be able to do that. Now we all know that for the first one being the sales price variance is just the standard price minus the actual price times the actual quantity, or standard price times actual quantity minus the actual revenue, and we are still going to get the same thing, right? So, or the actual revenue or actual association, you're going to still get the same thing. So I'm just going by this formula: standard price minus standard minus actual price. Standard price minus actual price. So standard price was given so we saw for KO. Standard price was given in the question to be 15 for KO. Now actual price was not given, right? So if you want to know it yourself, you have to divide. Now you divide the sales revenue by the number of units and then you get a price per unit, right? So we do that here. For 20,000 divided by 30,000. And we had 14. Now, if you want to use it to calculate the variance, standard price minus the actual price times the actual quantity. For KO, they produce 30,000. Now, 15 minus 14 here is going to give you 1. 1 times 30,000 is going to give you 30,000 adverse. Why adverse? It's adverse because when it's revenue and then the actual is less than the standard, it's an adverse situation. It's unfavorable. So here it's unfavorable. That's why it's an adverse. Then TO as well, we do the same thing. We pick the standard. TO, we pick the standard price. Standard price here is 10 minus the actual price. We will not get unless we divide the sales by the units. We get something and then we multiply it by the actual quantity and we get 17,500 favorable. Why is it favorable? Because when we divide this by this, we are going to get something above the standard price. So let's do that. So 3 500 divided by 35,000, and we are getting 10.5. So we are getting something above this. So 10.5 minus 10 is going to give us 0.5 times 3,500, 35,000. You're going to get 17,000. So that's what we've gotten here as favorable. We do the same thing for KA, and we are going to arrive at the same, we are going to arrive at this answer. All right, so now we go to the sales volume variance, where we also know how to compute this because we've learned about it, we've learned this, right? So sales volume variance is basically this. Normally, if you want to calculate the sales volume variance, you have to check the costing method that the organization is using, whether the organization is using absorption or marginal. So we look at that before we do our sales volume variance, right? So let's do that. So looking at the question here, we can see that we were not given anything related to fixed cost, but only variable. So this means that the organization is using marginal or variable costing. So we are going to use the budgeted contribution in doing that. So the sales volume variance for this particular people using the marginal is going to be the budgeted quantity minus the actual quantity times budgeted contribution. If this thing should have been using, if the organization should have been using absorption, we would have multiplied by the budgeted profit, right? So we will actually find the contribution for this, but if it were to be the other way around for the organizations that are actually using absorption, then we would have well, how do I even say that? We would have actually used budgeted profit instead of budgeted contribution. All right, so coming. All right, so now we have for the first one, the budgeted quantity in the question was 36,000. Now for KO, 36,000. And then the actual quantity they sold is 30,000 units, right? Now, when we subtract, then we multiply it by the contribution, right? Where the contribution is just the selling price minus the variable cost, the standard variable cost, right? Or the budgeted variable cost or anything like that. So we did that 15 minus 8 for the first one, and then we had 42,000 adverse. Why is it adverse? It's adverse because the budgeted quantity was higher than the actual quantity. That's why we are having an adverse here. Now we do the same thing for TO. 27,000 minus 35,000 times the contribution will be 10 minus 4. So we multiply and then we get this 48,000 favorable because the actual quantity was more than the budgeted. Just as simple as that. Now we go to KA. KA as for 18,000 minus 25,000 times 12.5 minus 7.5. We get 35,000 favorable. Why is it favorable? Because just the actual is what's greater than the budgeted. Then we are good to go. Now, our aim now is to break the sales volume variance down into quantity variance and then mixed variance. Now, the quantity variance just looks a bit complicated because we have to find the weighted average contribution to do that. Now, to find the weighted average contribution, we will do something. So let's just look at the sales quantity variance formula first, which the sales quantity variance is going to be the actual quantity, total quantity sold, the actual total quantity they sold minus the budgeted total quantity, or multiplying the weighted average contribution. Now, The weighted average contribution is the contribution for all the total contribution for all the budgeted units or all the budgeted sales, right? All the budgeted divided by the total units for the budgeted. Now we actually find the total contribution. You know that total contribution is basically the units times the contribution per unit, right? We are going to do more of this in break-even analysis and we are going to understand it more. So we multiply 36,000, which is the unit, by the contribution 7 plus this times the contribution 27,000 times the contribution, and then plus 18,000 times the contribution. We divide it by the total number units. Then we are going to get 6.22. I'm leaving it. You are going to get 6.22222222. I'm leaving it in two decimal place. Right now, when we use the formula where we are going to the actual quantity in total is going to be 90,000. So the actual total quantity is nothing serious. All we need to do is to add all the total units. So 30,000 plus 35,000 plus 25,000. And we are going to get 90,000. So that is the 90,000 you are seeing here. Then the budgeted quantity as well in total, let's do that. 36,000 plus 27,000 plus 18,000. And we are going to get 81,000. That's what we are seeing. And we multiply that one by the weighted average contribution. We get 5,000, 55,980, right? So depending on the number of decimal places you leave, or the number, yeah, depending the amount to be increasing by that particular amount, right? So now we've gotten the sales quantity variance. Now let's go and then check the sales mix variance, which talks about whether we've actually sold majority. So it is normally used to check whether the organization is having a larger market share or it's not having much of the market share. So it is given by the formula sales mix variance is equal to the budgeted sales mix for actual production minus the actual sales mix times the budgeted contribution, because we are using marginal costing. If you were to be using absorption, it would have been budgeted profit instead. You see? All right, so budgeted standard, the budgeted sales mix for actual production, we have to just find the proportion and then just mix it and multiply by the actual production, because we said budgeted sales mix for actual production. So we just take each one of the budgeted sales divided by the total, like the way we did for the material mix. We are going to do something similar, right? When I said if you were given in a form of ratio, yeah, so we are going to do the same thing. So you can just do 36,000 divided by 81,000 for KO. 36,000 divided by 81,000 times the 90,000. We are going to get 40,000. So you can see it's like this. 31,000 divided by 36,000, sorry. Divided by 81,000 times 90,000. We are getting 40,000, like what we are seeing. Or you can break the 36,000 down, 36,000 over 81,000 by, then it will come down to 4/9. It's still the same, right? So we are going to do it for all of them. Then we get the budgeted sales mix for the actual production. So this one has 27,000 over the total budgeted listing times the total actual listing, right? So we do it and we get a total for all of them, right? Then we now come and do the sales mix for them. So now we take the first one, the one that we computed, budgeted sales mix, 40,000 minus 30,000, which is the actual, right? Minus the actual times the budgeted contribution, as usual. We get 70,000 adverts for the first one. Here as well, 30,000 that we computed up here, minus the actual unit times the budgeted contribution. Then we get 30,000. We do the same thing for KA, 20,000 minus 25,000 times 5, which is the budgeted contribution. We get this 25,000 favorable. And this will make your work easy and peasy. So question 2 has also been explained and killed. If you don't understand anything, you can just put it in the comment section and I'll be glad to assist you. Please note that if you come in and ask any question, maybe 2 years or 3 years after this video, I might not be able to explain because now I've forgotten. I beg. Don't come 3 years and come and ask me, I beg. All right, so that is it for the sales mix. So the sales mix is just similar to the material mix, right? We just apportion it and then we get the standard mix for actual, but the budgeted standard mix for actual product. Actual production, then we are good to go. Now let's move on to the question 5. It is an interesting lesson. Then we leave here because I've solved it already and I'm just explaining. You see the way it is just straightforward. Forward to be writing like I'm not even done with question 1. All right, so the question 5, let's go and read the requirement. We should compute the efficiency ratio. So efficiency ratio normally talks about how we've used the hours. Like have we used the hours well, or we haven't used the hours? Or so when we are doing the efficiency ratio, we normally compare the standard hours to the actual hours, whether we've used more of the standard, like we've used more hours to produce or less hours to produce. Then the capacity ratio. The capacity ratio also let us compare the actual hours to the budgeted hours, right? And the production volume or activity ratio, we are just going to now compare the standard hours to the budgeted hours. Now, let's read the question. GG Limited is into fuel processing and transportation. GG Limited produces 3 types of fuel, namely petrol, diesel, and premix fuel. The standard time for production of the fuel types are 50 minutes per metric ton, 30 minutes per metric ton, and so petrol will have 50 minutes per metric ton, diesel will have 30 minutes per metric ton, premix fuel will have 45 minutes per metric ton. Now, the production budget for August is as follows. Petrol is having 40,000 metric tons. Diesel is having 60,000 metric tons. And premix fuel is having 45,000 metric tons. Now, the actual data for the month were as follows. 100,000 labor hours. This thing was 100,000 labor hours. Right now, you see, we are giving in minutes and here we are giving in hours. So it's either you change this hours to minutes or this minutes to hours, any one of them, so that you can actually be able to compute everything well. So the actual production here is 45,000. Because the actual data for the month was 45,000 metric tons, 50,000 metric tons, and then 40,000 metric tons. And we are required to compute the efficiency ratio, the capacity ratio, and then the production volume ratio. Now, the efficiency ratio is given by the formula, the standard hours divided by the actual hours times 100%, right? Now, question didn't give us standard hours, right? So you have to look for the standard hours we used for the actuals we are having here, right? The standard hours. We have to get the standard hours for actual production. And that's what we are coming to do. So you see, the thing is already in the time is in minutes. So let's convert it to hours. So 50 divided by 60 is we converting it to hours times the actual units. We get this 37,500. Diesel as well, 30,000 over 60,000. It means 30 minutes over 60 minutes, which is we converting it to hour times 50,000. We get 25,000. Premix 45 over 60 times 40,000. We get 30,000. And we add or we get a total of 92,500. Now, at 92,500 hours. Now, actual hours is already given here to be 100,000 hours. So, we just follow the formula. Standard hours is 92,500 over 100 hours. We multiply by 100% and we get 92.5%. So this is just trying to say that the actual hours we use in production was more than the standard hours set by 75%. So we actually use more hours, right? Instead of using some small time to produce more, we use more hours for this normal actual production. You get it? So we should have used lesser. That is what it is trying to say. And we should have used lesser, but we've rather used more. Now, the second part, which is the capacity ratio, we have to now find the capacity ratio is given by the formula actual hours worked divided by the budgeted hours, right? Times 100%. It's supposed to be times 100%. Forgot to bring the 100%. Yes, times 100%. So we are going to get, we have to find the budgeted hours, right? So we convert everything to minutes, hours, and then we get the budgeted hours for the budgeted unit or the budgeted production. So 50 over 60 times the budgeted unit, 30 over 60 times the budgeted unit, and then fuel as well, 45 over 60 times the budgeted unit. So I'm just using the 45, 30 and for from the time they've used, right? Now, when we do all of them, we are going to, and then we add, we are going to get a total of 98,750 hours. Now, it means the budgeted hours here is what? 98750. Actual hours is giving us here to be 100 hours. So now let's look at something. 100,000 hours over 98,750 times 100. Okay, yeah, about 100% here. It's going to be 101.27. Then what it's trying to say is that actual hours worked was 1.7%, 1.27% more than the budgeted, meaning we are not that efficient. We've used more hours. We should have used lesser hours. That's what it is trying to say. Right? We should have used lesser hours, but we've used more hours. Now, here comes the final part of this particular question, which is the production volume ratio, which is easy as well. So as far as you've been able to calculate your standard hours correctly and the budgeted hours correctly, then this one will be easy. So it's given by the formula standard hours over budgeted hours times 100%. So for the efficiency ratio, capacity ratio, and production volume ratio or the likes, we are all using percentages for them. So it is the standard hours over the budgeted hours. So we've already solved for the standard hours, which was 92,500. And we've also solved for the budgeted hours, which is 98,750. We divide and then we get 93, 93.67%. I didn't bring the percentage. 93.67%, which is trying to say that actual level of production was less than budgeted by 6.3%, which is we subtracting the 100%, 93.67 from 100%, and we get 6.33%. Yeah, so it's 1.27 more. We just subtract the 101.27. So it's just 101.27 minus 100, then we are good to go. This one as well. This one as well is the same thing, right? This one as well is the same thing. Yeah, we subtract, we do 100% minus 92.7 to 92.5, and we get 7.5, the same thing. So I'm sure you've enjoyed this brief video. This is actually short and straightforward. You can just download the documents, the answers. I'll upload the answers also. You can just download, solve yourself, and then cross-check and see whether you've done the right thing, right? Thank you so much for your time, and I'll see you in the next video where we start talking about performance management, okay? See you. Bye.